Let's talk about debt because almost nobody actually understands what it does to a country over time. And that gap in understanding is exactly why so many people get caught off guard when the ground shifts under them. This isn't a video about panic. It's not a countdown clock. And I'm not going to pretend I have some secret formula that lets me predict the next crash to the month. What I want to do instead is walk you through how debt cycles actually work, what history shows us happened the last few times things got stretched too far, and what a reasonable, diversified approach to protecting your money might look like. No fear tactics, no fake urgency, just the mechanics laid out clearly so you can think for yourself. Here's the first thing to understand: borrowing money is not inherently bad. In fact, most economic growth throughout history has been financed by debt. When a business borrows money to build a new factory, or a family borrows money to buy a home, that debt lets them do something productive now instead of waiting years to save up the cash. The lender gets paid back with interest, the borrower gets to use the money today, and in a healthy system, everyone comes out ahead. The trouble starts when debt grows faster than the income needed to pay it back. That's true for a person, a business, or an entire country. And because credit is elastic, meaning it can expand much faster than real economic output, it's very easy for debt to quietly outrun the income that's supposed to service it.
Let's talk about debt because almost nobody actually understands what it does to a country over time, and that gap in understanding is exactly why so many people get caught off guard when the ground shifts under them. This isn't a video about panic. It's not a countdown clock, and I'm not going to pretend I have some secret formula that lets me predict the next crash to the month. What I want to do instead is walk you through how debt cycles actually work, what history shows us happened the last few times things got stretched too far, and what a reasonable, diversified approach to protecting your money might look like. No fear tactics, no fake urgency. Just the mechanics laid out clearly so you can think for yourself. Here's the first thing to understand. Borrowing money is not inherently bad. In fact, most economic growth throughout history has been financed by debt. When a business borrows money to build a new factory or a family borrows money to buy a home, that debt lets them do something productive now instead of waiting years to save up the cash. The lender gets paid back with interest, the borrower gets to use the money today, and in a healthy system, everyone comes out ahead. The trouble starts when debt grows faster than the income needed to pay it back. That's true for a person, a business, or an entire country. And because credit is elastic, meaning it can expand much faster than real economic output, it's very easy for debt to quietly outrun the income that's supposed to service it. Economists who study long-run credit cycles, including well-known investors like Dalio, have pointed out that these cycles tend to have a short-term rhythm and a much longer-term rhythm layered on top of each other. The short-term cycle is the one you've probably heard of. It runs roughly 5 to 10 years. Central banks cut interest rates, borrowing becomes cheap, spending picks up, the economy heats up, inflation rises, and then the central bank raises rates again to cool things down. That cool spending sometimes triggers a mild recession, and then the cycle resets. Most people have lived through several of these. They're bumpy, but they're normal, and economies generally recover from them within a couple of years. The long-term cycle is the one people pay far less attention to, mostly because it plays out over 50, 70, sometimes closer to 100 years, which is longer than most people's working lives, let alone their attention spans. The idea is this. Across many of those short-term ups and downs, each recovery tends to be financed with a little more debt than the one before it, and each downturn gets patched over with a bit more borrowing rather than genuine repayment. Slowly, debt as a share of the overall economy creeps upward decade after decade. It's not dramatic in any single year. It's the kind of thing that's nearly invisible if you're only looking at 1 or 2 years at a time, which is exactly why it can go unnoticed for so long. Eventually, in this framework, you reach a point where the total debt load is so large relative to incomes that the normal tools stop working the way they used to. Cutting interest rates to encourage more borrowing doesn't do much when people and governments already feel overloaded with debt. That's often described as the later stage of a long-term debt cycle. Whether or not any particular economy is near that point at any given moment is genuinely debated among serious economists, and reasonable, well-informed people disagree about it. I'm not going to tell you a stage number or a countdown, because nobody can responsibly do that with precision, and anyone who tells you they can is selling you something. What we can do is look at history, because history gives us real, documented examples of what happens when debt loads become unsustainable and how different societies chose to deal with it. There are basically three broad paths a country can take once debt becomes too large to service normally, and it's worth understanding each one honestly. The first path is default. This means the borrower simply stops paying back what they owe or pays back only a fraction of it. Governments have defaulted throughout history: Russia in 1998, Argentina multiple times over the past century. Greece effectively restructured its debt during the European crisis in the early 2010s. Default is painful and disruptive. Lenders lose money, borrowing costs spike for years afterward, and it can trigger a broader loss of confidence in a country's financial system. It's the most direct form of debt destruction, and it's usually a last resort because of how damaging it is to a country's reputation and its ability to borrow in the future. The second path is restructuring, which is a softer cousin of default. Instead of simply refusing to pay, the borrower negotiates with lenders to change the terms, stretching out the timeline, lowering the interest rate, or reducing the ante owed, but doing it through agreement rather than outright refusal. This happens more often than outright default and tends to be less chaotic because it's negotiated rather than forced. Still, lenders take a loss and the borrower's credibility takes a hit. The third path, and historically the one most commonly chosen by countries that can borrow in their own currency, is inflation. This one deserves more attention because it's the quietest of the three, and also the one that affects nearly everyone, even people who never directly lent money to the government. Here's the mechanism. If a government owes debt in its own currency, it can effectively reduce the real value of that debt by allowing the money supply to grow faster than the economy. Prices rise. Wages eventually rise too, though usually with a lag. The government pays back the same number of dollars it originally borrowed, but each of those dollars buys less than it used to. In real terms, the debt shrinks even though the number on paper stays the same. This is sometimes called inflating away the debt, and it's attractive to policymakers precisely because it doesn't require an explicit, painful announcement the way a default does. It happens gradually through the ordinary mechanism of rising prices, and by the time people fully feel it, the political decisions that caused it are already years in the rearview mirror. Let's make that concrete with a simple example, because the math is worth actually seeing rather than just hearing about abstractly. Imagine a government owes $100,000. If inflation runs at a rate that cuts the purchasing power of a dollar in half over a decade, that debt is still $100,000 on paper 10 years later. But in terms of what it can actually buy, it behaves more like $50,000 did at the start. The lender who was owed that money effectively lost half of its real value, even though they were technically paid back in full. Nobody defaulted. No headline announced a crisis. It just quietly happened dollar by dollar over years of grocery bills and gas prices creeping upward. This is worth sitting with because it explains why inflation is often described as a hidden tax. It doesn't show up on your pay stub as a deduction. It shows up as your paycheck simply not stretching as far as it used to. And if your savings are sitting in cash or in assets that don't keep pace with rising prices, you experience a slow erosion of your purchasing power without ever seeing a single explicit charge. Now let's look at what actually happened during a few real historical periods. Because these aren't hypothetical scenarios, they're documented events with real outcomes for real people. In the 1930s, following the excesses of the 1920s and the stock market crash of 1929, the United States and much of the world went through a brutal deflationary depression first, followed later by significant currency adjustments. The stock market lost the vast majority of its value from its 1929 peak to its 1932 bottom, commonly cited around an 89% decline in the Dow Jones Industrial Average, though it's worth noting that figure reflects nominal prices in a period that also saw significant deflation, meaning the price of goods was falling too, which complicates a simple before and after comparison. Banks failed by the thousands because they didn't have deposit insurance the way banks do today. People who kept their savings in failed banks often lost those savings entirely. It was a genuinely brutal period, and it's part of why the United States eventually built institutions like the FDIC and Social Security, specifically to prevent a repeat of that kind of widespread wipeout. In the 1970s, the story looked different. Rather than a deflationary crash, the U.S. experienced high and persistent inflation combined with weak economic growth. a combination economists call stagflation, meaning prices going up while the economy struggles at the same time. Bonds, which pay a fixed interest rate, performed poorly in real terms during this period because that fixed interest rate often didn't keep pace with inflation eating into the value of the payments. Stocks, broadly speaking, went through a long stretch of choppy, directionless performance for much of the decade once you adjust for inflation, even though the nominal index numbers moved around. Meanwhile, gold, which had been fixed at an official price for decades under the Bretton Woods system, was allowed to float freely starting in 1971, when the US ended the dollar's direct convertibility to gold. Over the following years, gold's price rose dramatically, moving from around $35 an ounce to several $100s an ounce by the end of the decade. Though it's worth noting gold is a volatile asset in its own right, and its price has had long stretches of poor performance too, including much of the 1980s and 1990s. In 2008, pattern was different again. This wasn't primarily a government debt crisis, it was a private sector debt crisis centered on mortgages. Banks and financial institutions had built up enormous exposure to mortgage-backed securities, many of which were built on loans given to borrowers who couldn't realistically afford them. When housing prices stopped rising and started falling, the value of those securities collapsed. Several major financial institutions failed or nearly failed, and the resulting credit freeze spread into the broader economy, causing a sharp global recession. Governments and central banks responded with large bailout programs and aggressive interest rate cuts, along with a policy called quantitative easing, where a central bank creates new money to buy financial assets like government bonds, with the goal of pushing interest rates down further and encouraging lending. That response is part of why the 2008 crisis, severe as it was, didn't turn into a full 1930s-style depression. The tools and institutions built after the 1930s were specifically designed to prevent that outcome, and by most measures they worked, at least in terms of avoiding a total systemic collapse. I bring up these three periods not to scare you, but because each one teaches a different lesson and the differences matter. The 1930s teaches the danger of concentrated bank risk and deflation. The 1970s teaches the danger of inflation quietly eating away at fixed-income assets like bonds and cash. 2008 teaches the danger of excessive private debt and financial leverage building up in ways that aren't visible until they suddenly are. No two crises look exactly alike, which is exactly why preparing for the last crisis specifically is often the wrong approach. What tends to hold up better across different kinds of crises is genuine diversification, not owning one thing you think will save you, but owning a mix of things that respond differently to different conditions. This is where I want to walk through the idea of diversification a bit more seriously, because it's one of those words that gets used constantly in personal finance content without much explanation of why it actually works. The basic logic is this: different types of assets tend to perform well under different economic conditions and poorly under others. Stocks, generally speaking, do well when the economy is growing and companies are increasing their profits. Long-term government bonds tend to do well when inflation is low and interest rates are falling, because their fixed payments become more attractive relative to falling rates elsewhere. Cash and short-term instruments like treasury bills hold their nominal value and give you flexibility, but they can lose real purchasing power if inflation rises faster than the interest they pay. Gold and certain commodities have historically tended to hold up during periods of high inflation or currency instability, though they don't produce any income on their own and can go through long stretches of doing very little. Real assets like real estate can provide some inflation protection because rents and property values often rise along with the general price level, though real estate carries its own risks around liquidity, financing costs, and local market conditions. No single one of these is a guaranteed safe harbor in every scenario. Gold didn't protect people from the deflationary crash of the early 1930s the way it protected people from the inflation of the 1970s, in part because gold's price was fixed by the government during the earlier period. Bonds have been a phenomenal asset class during long stretches of falling interest rates and a mediocre one during stretches of rising inflation. Stocks have delivered extraordinary long-term returns over the past century, but they've also gone through decade-long stretches, like parts of the 1970s or the 2000s, where they went essentially nowhere in real terms. This is precisely why relying on a single asset class as your entire plan is risky, no matter how convincing the story behind that one asset sounds in any given year. A genuinely diversified approach spreads exposure across assets that respond differently to different conditions, so that no single scenario wipes out your entire plan at once. This doesn't mean you need dozens of exotic holdings. For most people, it means having some mix of stocks for long-term growth, high-quality bonds, or short-term instruments for stability and income, some cash reserve for flexibility and emergencies, and depending on your goals and comfort level, some modest allocation to inflation-sensitive assets like real estate or commodities. The right proportions depend heavily on your age, your timeline, how much of your income you might need soon versus decades from now, and honestly, your own tolerance for watching your account value move around. There is no single allocation that's correct for everyone, and I'd be doing you a disservice if I told you there was a magic formula that fits every person watching this. I also want to be honest about something a lot of finance content glosses over. Past patterns are not guarantees of future outcomes. The fact that gold rose in the 1970s doesn't guarantee it will rise the next time inflation picks up. The fact that stocks have historically recovered from every crash so far doesn't guarantee they always will, though it is a meaningfully strong historical pattern worth taking seriously. Debt cycle frameworks like the one popularized by investors such as Dalio are useful lenses for understanding history and thinking about risk, but they are frameworks, not crystal balls. Serious economists disagree about how predictive these cycles really are, how precisely you can time them, and how much of economic history actually fits the pattern cleanly versus how much gets fitted to the pattern after the fact. Healthy skepticism is appropriate here, even toward frameworks that sound compelling. So what does a reasonable, level-headed approach actually look like, given all of this? I'd suggest a few practical steps, none of which require panic or urgent action taken in the next 48 hours. First, understand your own timeline. Money you need in the next 1 to 3 years should generally be kept in safe, liquid places, savings accounts, short-term treasury instruments, things that won't lose significant value right when you need to access them. Money you won't need for 10, 20, 30 years can generally afford to take on more risk in pursuit of higher long-term growth, because you have time to ride out the inevitable rough patches along the way. Second, resist the urge to concentrate your money in whatever asset had the best recent headlines. Whether that's a hot stock, a cryptocurrency, or even gold during a period when its price is spiking, chasing the thing that just went up is one of the most consistent ways investors have historically hurt their own returns. Because by the time an asset is dominating the headlines, a lot of the easy gains have often already happened. Third, build in genuine diversification across asset types, not just across many stocks that all tend to move together. Owning 20 different technology stocks isn't diversification in any meaningful sense if they all fall together during a tech downturn. Real diversification means owning things that don't all move in the same direction at the same time. Fourth, periodically rebalance. Over time, some parts of your portfolio will grow faster than others and your original proportions will drift. Rebalancing means periodically trimming back the parts that have grown to be an oversized share and adding to the parts that have shrunk to bring yourself back toward your intended mix. This is a discipline that quietly forces you to sell high and buy low without needing to predict anything about the future. Fifth, and maybe most importantly, keep some perspective on the emotional side of all this. Markets are genuinely designed to test people's patience. Every serious downturn in history has come with a wave of commentary telling people this time is permanent, that recovery isn't coming, that everything has fundamentally changed. Sometimes fundamental things really have changed. But the historical pattern, across the 1930s, the 1970s, 2008, and plenty of other episodes in between, is that developed economies with strong institutions have generally found a way through, even when the path was painful and took years. That's not a promise about the future. It's simply what the historical record shows so far. I want to end with something that's a little less about markets and a little more about how to consume content like this responsibly, including content on this very channel. Be skeptical of anyone, including me, who tells you they know exactly what's about to happen and exactly when. Be skeptical of content that borrows a famous person's name or reputation to sell you urgency, especially when that content puts words directly in that person's mouth that they never actually said. Be skeptical of any plan that conveniently requires you to buy one specific product or asset right now today before some arbitrary deadline. Real financial planning is boring most of the time. It's about understanding your own timeline, keeping your costs low, staying diversified, and giving yourself the emotional distance to not make panic decisions during the scary parts of the cycle, whichever kind of scary part happens to show up next. None of what I've described here is personalized financial advice, and I'm not a licensed financial advisor. Your own situation, your age, your income, your goals, your risk tolerance, your existing debts matters enormously in figuring out what mix of assets actually makes sense for you specifically. If you want a real personalized plan, talking with a licensed fee-based financial advisor who has no incentive to sell you a specific product is generally a much better path than following any single video, including this one. What I hope you take away instead is a clearer sense of how debt cycles actually work, what history really shows about inflation, default, and restructuring, and why genuine diversification, however unglamorous it sounds, has historically been one of the more durable strategies for weathering whatever comes next. Thanks for spending this time thinking it through with me. Take what's useful, question what isn't, and go build a plan that actually fits your life, not somebody else's script.